Welcome to the weekly update, where I'll go over the action in the market for the week of May 8th through the 12th, and then we'll see how things look for the week of May 15th through the 19th. This is the first video that I've been able to do in a few weeks, so let's go back and see how things have changed. Before we get started on that, I have returned from traveling, and I'll try to get caught up on the videos just as soon as possible. I didn't anticipate making a weekly video this week, but things worked out. The travel time wasn't as great as I thought it would be, so this has given me a little extra time to try to do some more videos. I do have a new supplemental video that I posted about a week ago now, where I talk about the relationship between the S&P 500 and different ways of looking at interest rates. You might find that helpful. It's not out of date at all right now. I use a lot of weekly and even some monthly charts to look at that. Currently, we're not really in a decisive time in the markets, meaning that what I talk about in the video, if we go up, that's positive. If we go down, that's negative. We're still pretty much chopping sideways. I do have a podcast that's available. I make the daily videos available and the weekly videos available as podcasts. But for right now, they are just carbon copies of what you're currently watching. Every time I upload a video, I also have a PDF, not only for the video, but for the podcast, where I make all the slides and charts that I use available to you to download and then follow along. I do have a private Facebook group that you're welcome to join. I'm trying to post more in that group. And then any other platforms that you use that you might think that I could post to that particular platform, please let me know about that. I don't have a poll posted for this week. I'll try to get back on that next week. Also, every day I post what are called pivot points. Those are built-in support and resistance levels that we follow pretty closely. And that is updated on the community tab, and I can only do that in YouTube. Let's go back and talk about this week's session. For the week, the Dow was down 0.29%. Volume has really dropped to below average, not only on the daily charts, but we're seeing it trailing off on a weekly basis as well. The technicals, they're still hanging in there somewhat positive. We're chopping sideways more or less on the daily charts, and now that's starting to come over into the weekly charts. The markets are really fixated on inflation and interest rates, and that's been the name of the game, and it will continue to be the name of the game until we get into the next thing that the market decides to fixate on. Earnings are coming out. We're kind of getting near the end of earnings season, but those can still have a real impact on market movement. And then we're coming up to this issue with the debt ceiling. There's been some more information that has come out. They haven't really solved that yet. The market is going to get really nervous about that if something isn't done. Typically what has happened before in 2011 is they have this 11th hour deal. The market freaks out up until that point, and then something gets decided, and then we move on from that. Our trend is still weakening. It's positive overall, but the ADX continues to go down. It's below its moving average. So we are pretty much in a trendless environment right now, and I have a chart to show you that. For the week, the Dow was down 1.1%, the Nasdaq was up 0.4%, the S&P was down 0.29%, here they have it 0.3%, the Russell was down 1.1%, and those are small caps, and we're seeing some real weakness in small caps right now. For the week, the 4,100 level for the S&P has become very important. We came down to that level a couple of times and then bounced up off of that. If we come back down again to that level, we may see another bounce. If we fall through it, that could signal some greater weakness. There are numerous negative divergences that we're seeing, and I'll point those out, especially on the daily charts. This can often lead to longer-term weakness. Take some time for these things to develop, but we see them happening, and then eventually, if some weakness comes into the market, a lot of times it's being led by these negative divergences that we're seeing. And I really address those in the daily video. I'll have a few to go through in this video. The reason for this is that there's only a few really big stocks, the mega cap stocks, that are really influencing price movement. If they have an up day, we're up. If they have a down day, we're down. It's not a real broad participation by the market right now. There are also concerns over the debt ceiling. A week ago, Treasury Secretary Yellen came out and said there will be economic chaos if the debt ceiling is not raised. The president is meeting with congressional leaders. They met earlier in the week. Nothing really got solved. There was supposed to be another meeting scheduled for Friday. That one was postponed. It's political posturing going back and forth. The markets are becoming concerned that there may be a hard landing for the economy. This means that not only we have economic slowdowns and a problem with employment, but we also go into a recession at the same time. The opposite of that is called a soft landing, where we see economic slowdowns, but we don't necessarily go into a recession. The financial sector as well as bank stocks remained under pressure over the past week, and volume still remains below average. Going back and looking at each day, on Monday, price action was really flat ahead of CPI. It was also really flat on Tuesday. Not much really happened. Then on Wednesday, CPI came out, and it was a positive reaction at first, but then they kind of went, wait a minute. A closer look produced uncertainty about the Fed's policy path, and then we saw some weakness coming into the market. The markets then concluded that the reading in the core CPI, it wasn't going to really have an influence over the Fed, thinking, well, they may be able to cut interest rates anytime soon. That produced some negativity on the day, and we saw some problems. But the S&P did find support at that 4,100 level and was able to bounce up off of that. Then on Thursday, the markets could have rallied because the PPI report came in weaker than expected, but action was rather muted to that. The S&P closed near the highs of the day. That was a little bit stronger day. And weekly jobless claims are starting to rise. We're keeping an eye on this employment situation. That's been the real variable for the Fed justifying raising interest rates. Well, if we start to see some weakness in employment, that may change things for the Fed overall. Then on Friday, there was a late afternoon bounce after we went down to that 4,100 level again. The S&P suffered only a modest loss in Friday's session after it had been down a lot more than that. So let's go back and talk about what happened during the week. What you see now is a 10-minute intraday chart. Over here where you see the pointer, this is Monday, where we were pretty muted, both on Monday and then on Tuesday. There was a little gyration when we opened on Wednesday. That's when CPI came out. This was the initial positive reaction, but then we bounced down. We came back up. Then there was some more weakness. We came down to this 4,100 level, but then saw some pretty good strength coming off of that. Then on Thursday, we were pretty muted when the markets could have really gone a lot higher, but they just decided not to do that. Then on Friday, things were looking a little better again. We gapped up higher, but then spent a lot of the day going down. We hit that 4,100 level again before seeing some strength going into the close. So for the week, the NASDAQ 100 performed the best. It was up 0.37%, followed by the NASDAQ. And this chart only measures the 5 trading days, so it's a little different from Friday to Friday. The S&P was down 0.34%, and all of the other indexes ended up being negative. Year to date, the NASDAQ and NASDAQ 100 are performing the best, followed by the S&P. We have small caps which have turned negative. Then going back to the all-time high set in early January 2022, all of the indexes remain negative since that point, with the NASDAQ and small caps now leading the way lower, where the NASDAQ 100 has actually improved enough to come out of last place. Looking at our sectors, this covers the 5 periods over the week where communication and discretionary have been doing the best. Utilities were unchanged, and then all of the other sectors ended up being down on the week. Then here's our relative rotation graph. This looks kind of funky if you're not really used to this, but think back to your geometry class in high school when you had to deal with x-axes and y-axes, where the flat line here is the x-axis. Anything to the right of this line going up and down, that's a plus. Anything going to the left is a minus. Then we have this line going up and down, that's the y-axis. Anything above the x-axis is positive, anything below is negative. So the strongest stocks are going to be up in this right-hand box. And this is XLK and XLC. This is communication as well as tech, and these are the 2 strong areas right now. The other areas that are improving are in blue on this chart, and then we have a lot of areas that are continuing to show weakness. So this is the most negative part of the chart. And this is what I say when I'm talking about there's only a few stocks that are really leading the market right now. They tend to be communication or tech stocks currently. Looking at the sectors for the week, communication was up the most, followed by utilities and then staples as well as discretionary, where we had energy, materials, and financials were down the most. Year to date, communication, tech, and discretionary are doing the best. All of the other sectors are now underwater. Going back to the all-time high, energy, even though it's given up a lot of its gains, is still positive, followed by staples, utilities, healthcare. A lot of these are just recently turning positive, where it had been energy and then utilities that were looking somewhat positive with all the other sectors being negative. And then way over on the right, even though discretionary has been doing well lately, it was down really hard, followed by real estate and then communication, also improving more lately. Looking at sentiment, we're giving a reading of 58 right now. We're in the positive side. They label this as greed. I tend to see it more as being positive. When we get really greedy or fearful, or when we get to these extreme readings, and we're not there yet, here's a historical chart showing how back in March we came up out of that low. We were doing better, but now we've been pretty much chopping sideways as far as sentiment is concerned without giving an extreme reading. The VIX also is very low right now. The line chart ticked down slightly. We're well below 20 with the line as well as the bar, showing there's not a lot of fear in the market. And remember the old adage, when the VIX is low, it's time to go. It's been low now for quite a while, but the market so far has been holding up. The right X bear bull ratio is still pretty much in the middle. When we really pay attention to this is when we get extreme readings. That's when the market goes down. Or when we're really getting low readings, that's when the market is going up. We're just in the middle. This is another look at cash, which is represented by the 1 to 3 month T-bills compared to the tech sector. And this kind of goes against logic, so bear with me on this. When this black line is below this cloud and actually going down, that means tech stocks are favored and they're going up. If you look over here at 2022, that's when everything shifted. Well, lately what has happened is the black line's been coming back down, the cloud's been going back up, and this is suggesting that tech stocks are doing better than cash. The weekly reading from the American Association of Individual Investors shows that they're not extreme negative right now after getting a pretty low reading, but they're still pessimistic overall. We really pay attention to this when we get an extreme positive or negative reading. Then we use it as a contrarian indicator. We also had the preliminary reading of consumer sentiment where it really fell in the last reading. And the spread between the 2-year yield and consumer sentiment is getting quite wide again, just showing that there's not a lot of happiness right now. The latest reading from the active asset managers, we're not getting an extreme reading. We really start to pay attention to this when it goes above 80. We're currently at 65. When we're negative, we really start to pay attention down around the 30 to 20 level, but we're just at the midpoint now. The Ulcer Index also shows that fear is trailing off a bit. We're below the moving average, showing that we're in a very complacent environment. Looking at the economy, here's the latest reading from GDP Now, where we have forecasts anywhere from a little over 1% down to minus 1%. The current chart that I'll show you in just a minute has us at about 1.5% or so. Here is that chart, where this is actually registering at 2.75%. Looking at the spread between risky and not as risky bonds, when this line is going up, that typically means we're in a recession. It is going up slightly, so that's a bit of a concern, but it's not really spiking up at this time. We also look at the financial conditions index. When we get above this black line, that means we're in trouble. We're actually declining, and we're still below the black line. We also have a chart where we look at tightening standards, where it just shows the banks are getting a lot more stingy with who and how they're going to loan out money. It's rolling over a little bit, but these standards have been really going up. Trying to get a gauge on a recession, we look at a thing called the real-time SOM recession rule indicator, where we get concerned when we're above this red line. And you can see we're barely at the black line right now. This is not registering any problems. We also looked at the probabilities. When we get above this red line, that means we're in a recession, and we're currently just a little bit above the black line. The Brave Butters is also a way of looking at inflation. We are showing this picking up a little bit, so that could be a bit of a concern. Looking at inflation, this is the Inflation Now casting. It's pretty much flat overall. It declined a little bit as the different economic reports have been coming out. Looking at the Fed, as of the close on Friday, May 12th, There is an 84.5% chance that at the next meeting, which will be held on June 14th, the Fed is going to keep interest rates the same. Now, this could change at any given time. There's still 15.5% of folks saying that we're going to raise them another 25 basis points. If the economic reports going forward from here are either at or even greater than expected or stronger than expected, this number is going to really pick up. We've been seeing a real weakness lately. We're going to be getting a lot of real estate information in the upcoming week. If that area continues to show weakness, we'll probably see the probabilities go up even more than where they're at right now. But this does change every day, so we keep a close eye on this. Looking at the Fed balance sheet, it had been coming down as they were doing quantitative tapering. Then it spiked back up through the banking crisis, and now it's continuing to go back down. This is looking at the rate of change of the balance sheet, showing that they are starting to take things off of their books that had resumed where they were going up, but then the banking crisis for right now seems to be fairly under control, so now they're starting their tapering again. Looking at breadth, we're still positive based on price, and we're getting a little bit more positive based on volume. We're still above zero with the advanced decline ratio, even though we ticked down slightly. This is still positive overall. We're seeing a problem here, though. There's not a real breakout of the new highs, especially when we start to break out to the upside. We're just not seeing a breakout. So our 4-period moving average is declining, and our 10-period moving average is also declining. Accumulation distribution is still positive. It's above an advancing moving average, even though it turned down slightly. Looking at our trend, this is what I say when we're in a trendless environment. The black line is the ADX, and it continues to fall. It's also below its moving average. We default to positive because the green line's on top, but the green line is also declining. Our rune is still positive, but it's starting to come down. It's switched over to negative on the daily chart. The mass index is not generating a signal right now, so I won't cover that. Looking at some other charts, the daily chart, this is where we've been chopping sideways on the daily chart, and you can see down below where volume has really been dropping off. We're at the midpoint of the trend channel going back to 2009. The pivot points were slightly positive because we're above this midpoint right now. As long as we stay above that, that's more positive. If we drop below, that will be more negative. We're still above the 50-period simple moving average, which equates to a 200-day simple moving average. Our long-term trend continues to be positive on the weekly chart. The bullish percent index, we're seeing the same reading on the daily chart. We're right at 50 currently. And this is suggesting there's some weakness that could be coming into the market. The Chaikin money flow is looking fairly positive. The Chaikin oscillator rolling over a little bit, but is above the dashed line and advancing. That's positive. The longer term look shows where the Chaikin oscillator continues to be positive, even though it's rolling over a little bit. The force index, even though it's declining, is still above zero. That's positive. The McClellan oscillator, this is negative. We've dropped below zero and we are declining. The summation index based on price is going down, but it's still above zero. However, it has dropped below zero based on volume. Our oscillators rolling over with the slope, still looking okay with the TSI, the MACD, the PMO, the PPO, and then our longer term oscillators, the KST and the TRIX. Those are still looking positive. We're looking pretty much negative across the board on the daily charts. The Swinland trading oscillator, we're below zero based on price. We turned up slightly, but we're still below zero based on volume. That is negative. The PMO continues to be positive. We're dropping based on price, and we've dropped below zero based on volume. The PMOs that are rising continues to fall. We're also declining with the buy signals as well as the PMOs that are above zero. The RSI is still above 50, even though it's declining, so this is positive. The special K is coming right down to this red line. We're coming right up to the red line on the daily chart, and so far we've been rolling over. We're going to need to see some strength come into the market for this to stay long-term positive. The Stochk RSI, after giving us an extreme positive reading, is now coming back down, and the Williams percent R is still extreme positive. The Vortex, we're seeing weakness with the green line going down and the red line going up, but we're still positive. The ultimate oscillator is above 50 and advancing. That's positive. The money flow is also above 50 and advancing. That's positive. The Bollinger Bands were not really getting an extreme positive or negative reading. The rate of change going back 1 week since we were down, this is slightly negative. Going back 50 weeks, we crossed above the dash line, but now we're starting to cross down below it. That's longer term negative. The copy curve is currently not generating a signal. The weekly chart shows that we're still above the 10-period moving average as well as the 40-period moving average. We don't really pay attention to this chart unless we really start to fall, and then we start looking for levels of support. Longer term, we're still positive because we remain above the 200-week moving average, which is very long term. Looking at our different charts, the Heiken Ashi gave us pretty much a doji sign, but it's still positive overall. The Kegi chart continues to be positive. It's black and pointing up. The Renko has open boxes. That's positive. The 3-line break is also looking more positive. The ease of movement, going back 1 week, we were virtually unchanged. We're starting to come back down below this dash line on the 14-week. Nothing new in the point and figure chart. Our different trading systems, the Elder Impulse system for the S&P weekly chart has switched to neutral, and we're still positive with the parabolic SAR. We're negative on the daily chart, so we're getting a bit of mixed information here. Looking at the broad market, we're looking for divergences here. The S&P pretty much chopping sideways. The mid caps are showing some weakness, and the small caps are really more of a concern. All stocks continue to be positive even though they're rolling over. We have a recent golden cross. The mid caps are looking more positive. We actually had a death cross on the daily charts. We're seeing weakness here on the weekly chart. If that continues, we might see a death cross here. The small caps also have now given us a death cross on the weekly chart, where the Dow still remains positive even though it's chopping sideways. The NYSE showing some weakness but is still positive. The Wilshire also remains positive. The NASDAQ is really holding up better than the other indexes. It remains positive and could be breaking out above what had been pretty significant resistance. We're also seeing a little bit of a breakout with the NASDAQ 100. That remains positive. The FANG stocks are still in an overall uptrend, where ARK is continuing to be in a downtrend. The biggest software companies, even though they're showing some weakness, they continue to be overall positive. The bank stocks really showing a breakdown here on the line chart. The MACD is also negative, and we're getting extreme negative with the RSI based on 9 periods. Looking at the latest chart for the deposits for all commercial banks, it had really been going back down, but we ticked up just slightly in the latest reading. Looking at Dow theory, we've been chopping sideways with the Dow. It's a little more pronounced on the daily charts, but we're seeing a bit of a negative divergence here with the transports. Also a little bit of weakness with the utilities, so we want to keep an eye on these things. The broad market, the CRB index remains in a downtrend. Copper is really starting to fall a little bit, even though it's still in an overall uptrend. Oil has also been falling back down. It's around $70 per barrel. The dollar is trying to bounce back up after seeing some recent weakness. Gold hasn't really broken out yet. We're waiting to see if we can get back above these all-time highs. We get close to that, and then we end up falling back, but we're still in an overall uptrend. Silver also has not broken out yet and remains in an overall uptrend. Looking at bonds and interest rates, bonds still continue to be positive based on price. We're seeing overall declines with yields going from the 30-year all the way down to the 3-month, even though they did tick up slightly. This is a daily chart. Then looking at the MOVE index, which is the volatility measurement for bonds, we're not really seeing any kind of an extreme reading now. We compare that to the VIX, which measures volatility of stocks, and then we look at the difference between them. We're not really seeing anything all that out of line right now. We also look at a weekly chart of international yields with the US, UK, and Germany on top. We're keeping an eye on Japan. That's a separate little story in and of itself. I'm keeping an eye on that as well. If it starts to come to the surface, believe me, you will hear about it. Looking at our different relative studies, oil still is tending to do the best when we look at our intermarket analysis chart. Gold has been declining a little bit, but coming down just a little bit underneath the dollar, where we still have stocks and bonds that continue to underperform, going back to the all-time high. Bonds on a ratio basis compared to stocks really not breaking out yet. The stock to bond ratio, it's still showing that stocks are outperforming bonds, but we're starting to see some weakness in this. Gold is really breaking out when compared to the US dollar, and growth versus value shows that growth is still in an overall downtrend, but it's trying to really bounce back up. We also look at the NASDAQ 100, which is really outperforming the S&P 500. Gold is also outperforming the S&P 500. Low volatility stocks, which were the place to be in 2022, they've now come under weakness. We've seen a recent death cross with this ratio. The S&P 100 continues to outperform the S&P 500, and we're seeing a recent golden cross with this ratio. Discretionary continues to underperform. They really try to make a comeback, but they're just not quite there yet when compared to staples. And then energy, which was the place to be in 2022, is now showing real weakness when we compare it to the tech sector. Looking at our secular and cyclical trend studies, we only have one chart to show here. This chart shows the NYSE breadth thrust. After setting a low back in October of 2022, we're now bouncing up out of that. And that is a going forward type of signal that's also much longer term. Looking at our momentum, we're comparing what has happened in the past with what's happening right now. When we go back to 1998 to 2004, and it looked like we were breaking out above this trend line, well, look at what the MACD was doing. It was well below zero and barely got above its moving average. Then we saw that again. Here we go. We're breaking above the trend line. But the MACD was not really showing an awful lot of strength. We also look at 2007 through 2010. Looked like we were breaking out, but the MACD was actually going flat. Now we compare that with what's happening right now. The MACD is above zero and advancing, even though it's rolling over a little bit. So this is suggesting for the time that this breakout above this trend line is for real. Now, we're going to need to see the market really get some legs to justify that, but so far this is holding up. So what's our outlook for the next week? Here is the list of the different economic reports that will be released. And I get this list from a site called briefing.com. Some things to keep an eye on. The technicals, you can see we're showing some weakness in our weekly charts. We're pretty much mixed on the daily charts. We have a down day, it looks more negative. We have an up day, it looks a little bit more positive. Because of this inflation and interest rate scenario, the debt ceiling is also kind of a short-term news item that we want to keep an eye on. We're going to be getting some Fed speak that I'll show you here in just a moment. And then are we going to be getting any more banking information that could really spook the markets? Fed speak. This, I'm not going to read through this, but this just shows the upcoming week for the different Fed officials and the different speeches or talks that they will be giving. The one that the market's probably going to focus on will come at 11 a.m. on Friday. That is going to be a conversation with Chair Jerome Powell and Ben Bernanke, who was also a former Fed chair. The market's going to be looking for any kind of clues coming out of that meeting. The other ones, these folks are really important, but unless they say something really drastic, it may not have much of an impact. Although one to keep an eye on would be Vice Chair Barr. Last time he spoke, that kind of shook the markets up a little bit. Looking at the Stock Traders Almanac statistics for the upcoming week, we're coming into options expiration. We end up being up 45% of the time and down 55% of the time. And then the week after options expiration, we're up 64% of the time and down 36% of the time. But then looking at Monday, May 12th, we have a 57.1% chance of the Dow or the S&P going up if we look back historically. The NASDAQ is not quite as strong. It's up 52.4% of the time. And then over the last 72 years, we've been positive more than negative in May. Typically what we've seen is early strength in May and then latter weakness as the month moves on. Looking at our yearly statistics, I usually don't go over this all that often because this applies to the whole year. We are working off of a 3-0 trifecta, and that applies to the whole year. We had the Santa Claus rally for a +1. The first 5 trading days were positive. That's +2. January was up. That gave us a +3. That's a 3 trifecta. When all 3 indicators were positive, the next 11 months have been up 87.1% of the time with an average gain of 12.3%. Then for the full year, we were up 90.3% of the time with an average gain of 17.5%. The markets also like that we're split between Republican and Democrat in Congress. Here's a chart showing that on Monday we will have the 11th trading day of the month. That's where it says you are here. We tend to be a little bit positive. That's the green dash line. That's for the pre-election year. And then this red box applies to the whole week. Here's another chart showing that during pre-election years, we tend to see a pretty strong beginning to May and then some weakness before we bounce back up going into the latter part of the month. This is suggesting that same thing. The gray line also shows some initial strength and then some weakness and then a little bit of recovery. We're coming out of that sweet spot now. We have the dark blue line, which is the S&P 500, which could suggest that we might be running into some weakness. Then the debt ceiling debate. Here is a chart put out by Stock Traders Almanac, just comparing now with 2011. And these are all the different things that happened. This is the period that we're in right now. And then how the market reacted during that whole debt crisis situation. When we look at the performance of the S&P before and after, there's been a debt limit change going back to 1950. We start off kind of positive overall, then we see some weakness, then a little bit more strength. So this ends up being more of a short-term situation. So our scenarios, this is just for Monday. We can't really go with the down scenario right now because our charts are showing mixed. We're seeing some positive signs, but we're also seeing a lot of negative divergences, which is also keeping us from dealing with our up scenario because of those divergences. So we're continuing to default to the sideways to neutral trend because the ADX is weakening on the daily chart. It's below its moving average, also below 20, and the green line is declining, which is pretty much the same thing we're seeing on the weekly chart. So some warning signs. There are numerous negative divergences that are coming together right now. The VIX is showing a lot of complacency. The S&P is underperforming utilities. In a good solid environment, we would see the reverse of that. We're in a risk-off posture right now, meaning folks are getting out of stocks and getting into bonds. Small caps are underperforming, and we had a recent death cross on the mid caps looking at the daily chart. Earnings season continues, but it's coming to an end. Some positive signs. We do have some longer-term positive seasonality and setups that some of those I covered here. Some of those I just cover from time to time in the videos, but that applies to the whole year. Lower price levels may provide support, especially at that 4,100 level, and the NASDAQ may be breaking out above resistance. So thank you. I hope you found this helpful. It's been great to be able to get going again with the videos. I'm also going to try to prepare the intermarket analysis video as well as the deep dive video and get those posted just as soon as possible. So I hope you're having a great weekend, and I will talk to you in the next video.